Hey, another area that we can invest in when we're looking at investments is mutual funds. It is probably the most common thing that we are exposed to, the most common thing we have in retirement plans, and one of the best things to offer you automatic diversity and or accessibility. So we'll get into all those things. We've kind of touched on them before. Um, According to the Investment Company Institute, the US in 2023 had over 120 million people in investment funds, and over 71 million households had a mutual fund. And the typical mutual fund investor owns shares in three different kinds of funds. So that just lets you know it's not a one size fits all, but it is something that's out there and very popular. Again, like I said, retirement plans are the biggest place you'll run into this, but it's a really good thing we mentioned the other day for investors. If you have $100 and you can only buy one share of stock, or you could buy $100 in a mutual fund that had that stock, it would probably be better to do that because you would end up with a diversity already, and everything, not just one share of stock. So, what is a mutual fund? Well, a mutual fund pools the money of many investors. They are the shareholders, and then they invest it in a variety of securities. So it's kind of like going in with all your buddies and you all dump money in a pot, and somebody makes decisions on what stocks to buy. And that's the way it works, because you can have what do they call this, investor parties and investor groups, and they had different things. Book clubs might have them, etc. And they'd make decisions on their money and buy stocks. This is the same kind of thing, except you're with like-minded people who you might not be like-minded with the people that you're with, that want to invest in something that is either diversified or all tech or all transportation stocks or all food stocks, or there's all kinds of choices out there. Um, Over half of the households that are out there invest in mutual funds for easy reasons, for three reasons. One, it's easy. Again, you don't have to have the dollars to buy a share of stock. If shares or stock are only $25 and you've got 100, you feel pretty good. You can get 4 shares and do pretty good. But again, you could put $100 in a mutual fund and probably be able to share in maybe 20 or 30 stocks, depending on how big the mutual fund is. Someone else is managing it. Someone else is making the decision for you, use guys. They're making the decisions for you, whether to buy it, to sell it, to hold it. You can get into mutual funds that pay dividends. You can get into mutual funds that buy and sell a lot. You can get into them. We'll get into. There's all kinds of choices out there. And immediately you have diversification. Now, it may not be diversification among different areas to invest in, like having some transportation stocks and some that are in home or in a healthcare, and then maybe some that are in banking. Now, you can get mutual funds that are that diversified in themselves, but even if you went into tech stocks, they're diversified because they're investing in different tech companies. It's not all the same tech stock, the same tech company. The major reason that people get into it is because of the diversification and the professional management. And I would add in there that it's because it's affordable. You don't have to have a lot of money usually to get into a mutual fund, so it really does help. Also, be warned, as well as they tout them, as well as they say how great they do, and as well as they say they've had a phenomenal return in the past 10 years, portfolio managers are portfolio managers. They're human. They can make mistakes. So, it may have performed 10%. We always say the past is no representation of the future. They may have made 20% last year. They may not make 20% this year. So that's, you just got to keep that in mind when you're looking at things like that. And then because of the diversification, it offers you safety. An occasional loss incurred with one investment within a mutual fund is usually offset by other gains. So again, if one tech stock goes bad, you've got 20 others in that fund that are going to hopefully offset that. Whereas if you just bought that one share, 20 shares that went under, then that would have been your loss, period. So it kind of gives you that, like I said, instant diversification. What is a mutual fund? I don't know if this will play. I'll try. If it doesn't, you can download it from Blackboard and play it that way. It's a YouTube video. You may be able to find it too on your own. And of course, we get to go through an ad. Obviously, the whole ad.
registers with the authorities.
Okay, so now that you kind of got the basics there, I always feel like those maybe sum it up better than me because I kind of go off in 40 directions, for which I apologize. Closed-end funds. You'll hear that sometimes somebody will say this is a closed-end mutual fund. What does that mean? Well, there's about 450 companies that offer closed-end funds, and what that means is that the shares in the fund are issued when the fund is organized, and that's it. So it's kind of like the preferred stocks. So after all the original shares are sold, you can purchase shares only if someone else is willing to sell, and you can sell only if someone else is willing to buy. So when we talked about preferred stocks kind of having that, you have to have a specific market. Closed-end mutual funds work that exact same way. So they're not what we see trading all the time. It's not what you think of all the time, but they are out there. So sometimes you get better perks in certain companies or maybe a certain company that you want to own. So that's when you would get into a closed-end fund. It's not something that we think of all the time. Again, a professional fund manager manages it. There are ETFs, which are exchange traded funds. They generally invest in stocks and other securities in a specific stock or securities index, i.e., they'll try to match like the S&P 500, or they'll try to match the X stock, or they'll try to match Tesla stock or whatever. And so they're not actively managed by a portfolio manager, such as ETFs tend to mirror a performance of an index. So they're trying to copy what's out there. So a fund manager isn't saying now's when you buy, now's when you sell, those kind of things. So they're not typically actively managed by somebody. There's only about 3,000 investment companies that offer ETFs. So it's not something that's really great out there, but you do run into them, and a lot of people do like to get into them. An open-ended fund versus a closed-ended fund is exactly what you'd expect. Open-ended means you can buy and sell at will. You can get into a certain fund, get out of a certain fund, change, add to a fund, etc. There's not it's kind of like a stock in the stock market. Whenever, if there's availability and the market's open, you can buy it. About 8,000 companies are in open-ended funds, and the shares are issued and redeemed by investment companies, when you want to sell and buy. So it's really nice to do that. Something that you'll have to figure out on stocks sometimes is the net asset value. And the reason we have to do that is because, like with a stock, you bought it at $20 a share, it's worth $40 a share, so you've got a deal. You've got that one thing. But since this is a plethora of stocks, you're trying to figure out the value of the fund. So to get the net asset value of your fund, you take the fund's portfolio minus liabilities and divide it by the number of shares outstanding, and that gives you a net asset value. So that can kind of help you figure out what the cost is too and whether they can cover their costs. So an example, a portfolio of stocks, bonds, and securities are in the New American Technology Mutual Fund. It has a current market value of $996 million. The fund has liabilities that total $12 million because they're going to list all this when you look at investing. So this mutual fund has 40 million shares outstanding, which means 40 million people can buy into it. The net asset value per share is calculated as Again, that formula is the portfolio, assets minus liabilities, the same thing we calculate when we do our net worth, et cetera. That's what we're figuring out for this fund, is what the fund's net worth is. And then divide that by the number of shares that are outstanding. So we would take 996 million minus the 12 million of liabilities, divide it by 40 million shares, or take 996 minus 12 divided by 40, if you didn't want to carry all those zeros out. And the net asset value would be $24.60 per share. So that gives you an idea of what the cost should be. So if you're buying it at $50 a share, it's a little overvalued. If you're buying it at $20 a share, it's a little undervalued. So so you can make that decision on what's a good buy for you. You can look at it that way. The net asset value shows you the financial health, kind of like the assets minus liabilities equals your net worth. That's what we're doing with that. But then again, we're looking at how many shares are outstanding. So if they went under, could they pay for all those shares? And that company that we just calculated could 24 times over. So that's what they're looking at there. Okay, there are fees, there are costs for having a mutual fund. It's not free for all, it's not free. It's, there's fees involved. In the past, I always love to take you back to the past. In the olden days, those things were printed. They had to be, but they were kind of hidden, and people didn't really know what they cost. And if you talk to a broker about getting in the market, they never disclose that. And then you get your statement, and you're like, "Why did it make a 25% return, but I'm only making about 20?" Well, that 5% return was spent on fees. So now, because we're consumers and we are important and we're investors, they have to disclose all those things. Now, it may be teeny, tiny, tiny, tiny print, but they're disclosed. You can see them. There are load and no load funds, and you kind of have to think about this. It's basically fees and no fees, and advice and no advice is where it breaks down to. A load fund, you pay a commission, which is like a sales charge, up to 8.5%. Typically, fees are between 2 and 5, so you want to be sure you keep that in a good range for you. But then they have somebody there to help explain the fund and offer advice and see if that's the fund you should be in, and etc. A no load fund is one you're going to get into if you know everything you need and you have it all figured out, and you pay no sales charge up front, and you deal directly with the investment company by internet, telephone, or discount broker. And so that's typically what most people do. But like if you have a stockbroker that you work with, they probably have you in a load fund. If you're doing all the investing on your own, you probably have a no load fund. The other thing to keep in mind is there can be a contingent deferred sales load. There's got to be a little play on words all the time. And basically, that means you're not charged when you buy it, you're charged when you sell it or withdraw your funds. It's referred to as a B fund. The other one was an A fund. This is a B fund, and it's a back end fund. Fees can be from 1 to 5%, and typically it's just deferred until you withdraw. And charges generally kind of decline the more shares you own, and et cetera. And if you've had it for more than 5 years, sometimes there's no fee. So there's could be perks in there that still keep it as a no load, but they call it deferred because there may be a fee on the backside when you sell it. There are management fees. Management fees average excuse me, 0.25% to 2%. Then there's 12B1 fees, 12B-1. Those are a distribution fee. Those are annual. They cannot exceed a 25.25 or 2.5% of a fund's assets for the year. They're levied on certain shares that have no sales load and then maybe have a deferred fee. So there's a bunch of fees that you'll see when you're in there. The expense ratio is going to have the 12B-1 fee, and then it's going to have an operating fee, and then it's going to have a prospectus that tells you all the fees, management, sales, etc. This fee hopefully is going to be at 1% or less. That, of course, is our ultimate goal so that you're not eaten up with fees. And again, you can see what fees are here. So Class A shares, Class B shares, Class C shares. Again, remember A had the fees, B and C did not until you cashed them out or didn't have any at all. But they might have a sales charge. One had a smaller sale charge, but then had the class B that had no commission, they had a sales charge, and class C did too. And then when you redemption fee, none of them had that. So, just keep in mind you kind of have to look, especially if you're comparing mutual funds. It can get a little tedious trying to compare all the different fees. Just kind of overlook each one and see what the total fees are. There should be a total somewhere that they tell you how much it is, or they may sum up like the commission charge, no commission charge, and then they'll clump the management fees together. And so you can look at management fees, distribution fees, other expenses. So total fees end up being that bottom line, which is 0.92 for class A, 2.27 for B, and 1.75 for the C or deferred. So that way you can kind of be sure that you're operating. Now the Class A looks great because it's got only 0.92, but remember it had a commission of 4 point whatever first. So just keep in mind you've got to compare all those fees and add them up and make sure that you're getting the best bang for your buck, so to speak. This just summarized what we just said, what defines each one for you: load fund, no load, etc. So you can read that on your own. I don't have to regurgitate that to you. So what do you choose? It's kind of like choosing paint colors. How do you decide what you're going to do? Well, figure out what you want it to be. Do you want it to be an equity fund? That means it's going to pay dividends very regularly, so you know you're going to have cash coming in that can either be reinvested or paid out to you. Do you want it to be defense funds? They call them defensive funds. There's a defense fund for like things that are making things that we use in war. There is a fund for that, but they're defensive funds that mean that they've been kind of stable. They're probably not a super high growth, but they're also not a super big loss. And they kind of maintain their value when the market goes up and down. They're not a vacillating up and down. They're kind of even Steven, level keeled, moving forward. So they're kind of what you look at for that. There's conservative funds. They can go to large cap. You can have an intermediate growth. You can have a long-term government corporate bond fund. You can get into bonds and mutual funds, which is kind of a nice way to check them out. Then there's speculative, which can be aggressive growth. You want a high growth. Global funds can be considered speculative because you're investing in the world. The junk bonds that we talked about that kind of have a high yield, but they have a high risk, those can be in that speculative. Sector funds, companies within the same interest, small cap, small businesses. So again, you can, depending on how you fill out in your investment comfort zone, you can find a mutual fund probably to match it that's already diversified for you, so you don't have to make those decisions. There are socially responsible funds. We talked about, if you are you want to preserve trees and save the trees, there's something out there for that. If there's there's just anything for, I think there's a mutual fund for just about anything you want or believe in. So it can really help. There are asset allocation funds, which means they have stock, bonds, fixed income, and money market. Index funds are going to follow an index like the S&P 500. As we talked about, everyone tries to mimic that one because it's the 500 funds. They may have a life cycle fund, which basically means they're trying to get you in your life cycle. So they're starting off a little more aggressive the younger we are, a little balanced when you're in your growth years and adding children and et cetera, and then a little more conservative when you get to your retirement years. So they're following that speculation with those kind of funds. There can be a total stock market funds. What's the Dow doing? What's the whole market doing? You can have that. It has exposure in large cap, small cap, mid cap, and stocks traded in the United States versus, overseas. You also can have, with everything that goes on, a family of funds. So think of it like a family. And what that does is basically you can have one investment company, but they have a bunch of mutual funds that they manage. So that becomes their family of funds. Each fund within the family will have a different financial objective. Sometimes you see that with, I think Fidelity, I know, has a family of funds, and you could just buy into the Fidelity family and get investments into tech, into stocks, into S&P 500, into bonds, that kind of thing. And then you can move your money from one fund to the other within that family, usually for no charge or transaction. So sometimes that's a way somebody goes to do that. So just know that there is that option out there for you. So when you're trying to construct your portfolio, what should you think about? What do you need to talk about? What do you need to think and process? Well, we've talked about if you have a little bit of diversification and you have things across all spectrums of the investment market, you're probably going to weather ups and downs, high interest rates, low interest rates, etc., a little better. So by looking at different types of stocks, different types of bonds, different types of funds, and other alternatives that are out there can help you kind of reduce the risk of everything. And I always say all your eggs in one basket. And if you don't know where that statement comes from, if you haven't heard it, because it's kind of an old statement, think of it as somebody walking from the barn, from picking up all the chicken eggs, and they have all their eggs in one basket. If you trip and fall, all those eggs are gone, more than likely. So it's doing is making sure that if the market falls, you don't have everything in one stock and you lose everything. It's making sure if the market soars, again, you don't have everything in one stock, so you don't maybe soar as high, but you still soar. So you want to take advantage of the highs, you want to minimize the lows, and you want to be sure you've got something steady in there too. So that's where that comes in when you're thinking about that. Things to think about when you ask yourself questions. What do you want to invest in? What are you looking at retirement? What's your state of life? What age are you? What's your risk tolerance? All those things can enter into it. Mutual funds, most of them are managed by some kind of professional. They have a professional fund manager or a team of managers. They will tell you who the fund manager is in the prospectus when it comes out, and that's the written, typed up thing that tells you what the fund is, which stocks they have, how their performance has been. Now, they will always tell you their past performance has been at 18% of the market. That's great, but we're concerned about what the future fund is. So that's what you're trying to look at. Have they weathered ups and downs in all markets that way? Have they weathered it through just the last year with a lot of growth in the market? So you kind of want to see what their bragging rights are and specify exactly how that growth has taken place. Also, they'll tell you who the fund manager is, and they'll give you a big bio history. And a lot of times they'll tell you who the fund manager was when they had the 18%. We don't care who the manager was. We care who the manager is, because that's where you're putting your money in now. You want to know who's managing it now. What's their history? Do they have a good track record, kind of thing? And then something else to keep in mind is if you're in an index fund, it's going to mirror it. It's not going to be it exactly. It's probably going to have a little lower expenses too than if you try to buy all those stocks. Well, definitely a lot lower than if you try to buy them all yourself. Some of the funds that they out there they call indexed funds that they're trying to mirror is the S&P 500. They may have a growth index, a bond index, and basically what they're doing is they're looking at the whole index for bonds, the whole index for the stock market, the whole index for the S&P 500, and trying to mirror that and getting the best return for that they can. Of course, the internet gives you a plethora of information. Just always use trusted sources. I'm always going to tell you that. And look at investment companies, look at ratings, look at, and know that most people that complain on an investment probably lost money, but look at how they're rated, how they're looked at. Are they easy to work with, easy to trade with, especially if you're getting a professional advisor or a personal advisor, you want to be sure that they're vetted and et cetera, because you kind of want to know, something about them. And then, of course, this just gives you an overview. The book loves to give you charts and tables and overviews, but you can look at the largest mutual fund asset management in the country, in the United States. BlackRock is number one, Vanguard is number two, and Fidelity is number three. And so you can look at those three and see how much assets they have under management in the trillions, all three of them. And then they tell you what they're known for. BlackRock, their purpose is to help more and more people experience financial well-being. That's their motto. The Vanguard Group has always been the leader in low-cost investing. Fidelity has been in the fund market forever, so it's got investors that have, 10,000 funds that are in the Fidelity family of funds. So, you just there's different ones. You don't have to all of us be in the same fund. So just know that there's some funds out there and you can look at them. If you want some professional advisory services and you want somebody to give you some direction on this, you can do that. I would also tell you do a little research on your own. and kind of figure out. You could probably, you can't really give yourself advice, but you could kind of arm yourself for advice before you go in and pay for advice. But, look at the fund analysis, look at the performance, look at the sustainability, look at the risk, what's the price. Kind of keep up with it all. So looking at like T. Rowe Price Research Fund, Morningstar website gives you this printout of this fundamental data about the fund T. Rowe Price equity research. That's what it is. So by looking at that, we're able to see what the net asset value is. We're able to see what the fee ratio is, the fee level, the share class, the type of category, and of course down here at the bottom, their growth from 2014 to 2023. So it's gone up. It's had a few down markets. I mean, you can see it's had a couple of dips. Maybe look what those dips were. Was that during COVID? Was that during a whole down market downturn? Or or do they have it in something that's unique to that? So it kind of gives you some good information there that you can figure out if that's the best thing for you. The prospectus again is going to list what they're invested in, what the fees are. They're going to tell you if it's a dividend paying fund, how capital gains are done. Again, because you're buying stocks, you aren't personally, but the fund is. There will be capital gains short term and long term that you have to claim. It'll tell you about the fund's management. It'll tell you if there's any limitations. It'll tell you that it's open, when you can buy set shares, how you can sell it, if it's a closed end, front end loaded, etc. So it'll tell you everything you need to know in the prospectus. The annual report that comes out, because you're a stockholder in this mutual fund, but you are a stockholder, you'll get an annual report. And the mutual funds will usually give them an annual report just like the stocks do, and they kind of detail what each stock's annual report said. And so they give detailed financial information. And then there's a letter from the president, and then hopefully there's also a letter from independent auditors. And what that's doing is just making sure that what you're invested in is all your money is invested. They're not skimming off the top. All the dollars in or buying stocks, and that all those funds are performing exactly as they've said. So they're not, telling you it's making 4% return and it's really making 10 and they're keeping 6. So that's why you have independent auditors to make sure and do the money trail, do the paper trail. Of course, there's, when you're trying to figure out where you want to invest, there's things to look at: the Wall Street Journal, Bloomberg, Kiplinger, fund categories, look at returns for a year, look at 5 and 10 years, what the expense ratios are, and all that kind of stuff. Now, the funds may or may not be in a retirement plan, 401k, etc. A lot of the mutual funds, your first foray into mutual funds, if you don't invest on your own, will be in your retirement plan. If you have a 401k with self-directed investments, not all allow self-directed investments, so just know that. But if you have one with self-directed investments, it more than likely will be into a mutual fund. Because again, you've got small dollars going in, can't afford to buy one stock, and they're not going to keep up with each individual person's stock trade. So by doing that, you're going to have, having the knowledge of how mutual funds work, knowing if you want one that's growth, equity, paying dividends, um, technology, whatever, gives you a leg up to figure out how you want your money invested. Or you may want to split it between 2 or 3 accounts. They usually have a pro rata sheet that you can do, just, all in one account, all in 2 accounts, or split it up between 4 or 5. If it's in your retirement plan, those gains and losses we talked about, you don't have to report them. If it's in your IRA, you don't have to report them until you take the money out. Then that stuff is reportable. So it's one of those things that grows tax deferred until you take it out. So that's the reason retirement plans have gotten into all this, because it really does help. With mutual funds, you're not having to report all the, stock trades, dividends paid, etc. each year. It just grows in that account and keeps growing under for your retirement. And then when you start taking it out, all of it is just taxed as regular income. You can open an account from $250 usually to over $3,000 and begin investing. Some of them will let you get in for as low as $10, and some of them let you get in as low as $1. So just find the right fund for you and the right thing that you want to do. The advantages of a mutual fund over stocks is ease of buying and the ease of selling. You're buying into a fund, so you're not having to track each individual stock. If you're tracking each individual stock, you have to see when it's going to be at its height. So you're having to do a lot more monitoring. Is it stock? What's the stock today? Did it go up 5? If it went up 5, is that all it's going to go up? It's going to go up 6. And I can tell you, I've probably told you this before. I instinctively don't sell at the top and don't buy at the bottom. I have a little something that kicks in and I go, well, it might go up a little higher. Oh, it's not. I'm selling. And so I miss the peak. I get in at the upper top, but I don't get the peak. And the same thing with buying. Well, it might be cheaper tomorrow if it's going down. And it's not, so then I buy. So I don't ever hit the very low and the very high. I'm kind of that I'm a day late kind of thing. So having someone else monitor that for me is a lot better because that's their job. They're professional at it. Of course, it is professionally managed, so just we just said, so I don't have to do that. It offers diversification for you right off the bat. There are multiple ways to withdraw it. You can take out interest, you can take out a monthly income, you can wait and sell it all at one time. There's all kinds of things you can do. And then, of course, you can do with mutual funds just like you do with stocks. If they're paying dividends, you can reinvest them. If it's a bond and it's paying you interest, you can have the interest reinvested and buy stocks. So it kind of helps you with that to be able to do that. Capital gains can be reinvested. You don't have to take the cash on those things. And then, like we said, if you're in the same fund family, you may be able to jump between funds without there being a fee for each time you do that. A lot of times with your retirement plans, that's what it is. They have one family of funds, and then you choose the different funds underneath that family, and so that way you can bounce around. You wake up and the market's going down, and you have all tech stock, and it's the technology that's going down. You could change your tech stock the minute you get up and change it to the other one, and there would be no fee for doing that. So you're not double whammy. So again, that's what most retirement plans have if they offer self-directed investments. So that kind of helps you. They don't usually offer a Schwab account and a Fidelity account and different brokerage firms. They usually are offering a family of funds under one. Of course, the other thing that you're paying for when you do that is online traders. There's usually a toll-free number. You get a complete record of transactions, and they have savings and checkings account. We talked about they're considered a financial institution. Brokerage houses are, but they're not a bank because you can't really get a loan or do other things there. Disadvantages, always want to give you the downside. There's could be purchase and withdrawal costs because we talked about some of them are kind of heavy laden in fees. So be sure of that if you're doing a lot of buying and selling. And that you may have management fees that go on each year that, because you're holding the fund and keeping it, well, they have to pay the lights and pay the personnel. So they're going to have a management fee every year. And those 12B-1 fees, they're going to have each year also. So that's kind of a downside in that you don't ever get away from the fees. Poor performance. I told you earlier that they try to mimic the S&P 500. They can buy the exact stocks that the S&P 500 is in, but they can't mimic every individual trade on the S&P 500. So that's why it's trying to match it. So the S&P 500 could have an 8% return, and your fund could have a minus 4% return. That means they didn't follow it very well at all in my book, but they more than likely they would have like a 6 or a 5% return, and you're like, well, that didn't match the S&P 500. Well, that's why. They're trying to match the trading that went on that day to take in the same gains and losses that the S&P 500 had, and it's a little hard to mimic that when they don't have all the people buying and selling like the stock market does. So you could have poor performance. They're not guaranteed to never lose. They're not guaranteed to never go down. They're not guaranteed to have that exact rate. So by not guaranteed, it means you could have losses. It's not a you'll never lose your account thing. I mean, you could. And then of course you give up your ability to control which stocks you want to buy, how capital gains are distributed. If you're in a bond fund, how bond money is distributed, where it's deposited. You give up that control by having a mutual fund account. So that for some people, not having control is very frustrating and difficult. And of course, as I just sort of mentioned with the S&P 500, there is a market risk associated with all investments. So there's no guarantee. There's no anything that's in the stock market. There's no guaranteed fund. So you just have to keep in mind, stocks go up and down, and bonds don't usually go up and down. They can, but they don't usually. They're pretty steadfast. Certificates of deposits are very steadfast. They don't go down unless you cash them in early. You might have a penalty there. So you just have to understand that there is risk with that. And some shareholders, as that said, are aggressive. So, I mean, some shareholders, some stock advisors on that. So you want to be sure your account representative is not one of those pushy people. If they are, I would suggest, especially if they're bothering you, change account holders, change account funds. Shareholders can receive a gain or a return in a couple of ways. You get dividends that can be paid directly to you. You can leave them in the account. You can, if it's not a retirement plan, you'll be taxed as regular income, and you can have them reinvested. You're still taxed on them, but you can have them reinvested. Then if they sell long-term gains or short-term gains, you'll have to report those. Again, you can't control when they sell, so you don't get to control when the short-term gains are in the long term, but you'll have to report those also. And if they distribute the capital gains, you have to figure out something to do with that because you've received cash. But anyway, you just have to figure out tax-wise how to do that. Okay, purchase option. Closed-end funds, exchange traded funds traded on the securities exchange or over the counter markets. Open-ended, no-ended funds are purchased through the sponsoring investment company. And then open-ended load funds are purchased through an authorized account executive or salesperson, because the load fund, remember, had to do with commissions. So if you're paying commissions, you're buying through a person. The open-ended no load fund means there was no commission, so you can buy that through the investment company, E-Trade, Vanguard, Schwab. And then closed-end and ETFs are traded on the market. There's nobody involved in that. You're making the decisions, and they're done through E-Trade, Schwab, Vanguard, etc. Both no load and load funds can be through a mutual funds, what they call supermarket, versus in a brokerage firm. And then open-ended, that's the one you can purchase and set up a savings plan with it. It can have regular transactions. You may have a reinvestment plan. So there's some options there with the open-ended mutual funds for sure that you can do. Now, say you want to have withdrawals. You need cash. You need to pull something out for an expense, to boost your checking, to pay for gas right now. So you'd want to be sure that you can do that. An open-ended fund, as we talked about, you can buy and sell all you want. A closed-ended fund, remember we talked about it, just has a certain number of shares and a certain number of buyers, so you have to find a buyer to buy your shares. So it's a little trickier in trying to get that cash out. So you want to keep that in mind. If you're not planning on using it for withdrawals, that might be the way to go, but you just want to be sure of that. The ETFs can be sold over the counter, on the market, etc. They're great on that, so you can just buy them and sell them as you want. You can sell a number of shares. You can sell it for a certain dollar, however you need it to be. So why do we get mutual funds? Well, again, they're easier to purchase. They still take work, and you still have to know how you want to invest your money overall. And your risk tolerance is still necessary, but there's a lot of investment options out there, a lot of ways to purchase things, and a lot of ways to take advantage of gains, losses, dividends, etc., and be able to, again, easier to purchase and not have to have the initial upfront higher investment of buying individual stocks. So if you have any questions, give me a holler. And if not, thanks for being here.